S&P in correction mode. NASDAQ crash mode, over 20% down. Bonds are getting hit. What do you do? Where do you go from here? We got lots to talk about. Sit back. Let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, I am a practicing financial advisor. What you see here, I do apply to our investment process. Most importantly, our models and portfolios. So if you like what you hear and see, please do consider subscribing. Questions, concerns, comments are open below. So lots going on in the market, right? You've got the Fed ready to raise rates, inflation staying real sticky, okay, and the Fed ready to make its worst policy mistake in history. All of this is not a good combination of events for the markets. But as always, we've got some ideas. We're going to talk about where we are, where we're going, what to prepare for. Let's go to the big charts. All right, here we go. Cycles. This is where we start with our process. Very important, okay? The macroeconomic data, what we see underneath there is going to drive the growth picture. Then we have the inflation, same thing, being driven by data. And then you've got policy, okay? So those three factors help us know where we're going in the economic cycle, and most importantly, can help us choose the right investments as we go forward, okay? So when you take a closer look here, we are now in cycle 4. Growth is slowing. We're going to show you that in a big way. Inflation decelerates. You're saying, wait, what? Hold on. I'm not saying it's going away, but we are seeing deceleration from a rate of change standpoint, okay? And policy, we know what's going on with policy. Horrible mistakes going on at the Fed, as hawkish as they have ever been. So let's take a deep dive here. The growth picture came out on Thursday. GDP minus 1.4%. Big shocker, okay? Our research firm didn't anticipate that. So what does this mean? Well, if you have 2 quarters in a row of negative growth, you are in a recession, okay? A lot of people have called and said we're already in that recession. This gives some credence to that, okay? Next up, GDP now for second quarter, looking at 0.5%. It's early. Expect this to go lower based on some of the things that we're going to talk about in a second, okay? Next up, earnings. So growth, earnings per share, etc. This image comes from a big Wall Street firm. Not going to tell you who, but this is the typical way that Wall Street looks at earnings. When you look at these numbers, not going to point them out, you can see them. Everything looks rosy. It's up. It's good. Well, when you look at what companies do, they can put whatever number they want, and they're going to beat that number, okay? You have to look at it from a different perspective. Here, through Friday, 260 companies minus 1.25% earnings growth. You have to understand, from a rate of change, last quarter, we're coming off 38, 25% type numbers to the upside to a negative. That is a huge downturn on growth. Another reason why the growth picture is in fact slowing, okay? Inflation, Ronald Reagan, violent as a mugger, as frightening as an armed robber, and as deadly as a hitman, right? Inflation. Everybody is feeling the effects of inflation right now. The threat of a global buying strike, right? People aren't making the money. Earnings, personal income is up. But when inflation's here, net, America is struggling. You see it in the savings rate. You see it in expenditure. Keep in mind, the consumer is 70% of GDP, and if they're not buying, that again is going to reaffirm our growth slowing story. Inflation, the other big news, of course, are the lockdowns going on in China. This is going to affect what? The dreaded word, supply chain, okay? Here's a chart real quick. This shows you basically standard deviation. Standard deviation is up or down how things move, right? So this shows you standard deviation on global supply chain pressure. Hello, look at that spike. That's a 5 standard deviation, 5 times normal. There's a program I have, actually a website I go to, and it shows all the ships lined out. Hundreds and hundreds of ships lined in the ports of Shanghai and now in Beijing that can't get out, can't unload, and or pick up. That's going to hit us as we go forward. But again, inflation, it's going to stay sticky, but we do anticipate it to slowly roll over. That's disinflation, not deflation. Deflation is a big crash, right, as far as price. Disinflation means it's slowly on a rate of change will go down, and you can see here, core goods, X cars and trucks are in fact slowly rolling over. So let's talk about the Fed policy and what's going on here. The Fed that failed. This will go down, in my opinion, many others, as the worst policy mistake in history of any Federal Reserve. Okay? You're talking about trillions and trillions and trillions of dollars thrown at this market for the last 10 years. For what? Right? For every $11 spent, you get $1 of GDP growth. Think about that. That's how bad this policy has been. And think about it this way. You give a young child some candy. They're running around. They're doing what they got to do. You take it away. What happens? Boom. Right? They crash. Same thing is going to happen here, okay? Hot economy, rising inflation. The Fed has never fixed a problem like this successfully. They've never had a quote-unquote soft landing. If you believe in a soft landing, you believe that transitory inflation, okay? Not going to happen. But don't worry, folks. Look who's at the helm, okay? This is a list of all the FOMC members and their experience, okay? Job outside the Fed. Never. 2 academia, 1 at McKinsey, of course, Powell Carlyle Group. This is who's running our Federal Reserve. I've spoken about this book many times. Fed Up. What a great book. It's now about 4 years old. Read it. This will tell you how dysfunctional the Fed is. Reaffirm. I'm reading a book about the 30s right now, the Federal Reserve and what was going on after the crash. A lot of the same mistakes are going on, okay? So what the Fed is trying to do, right? They have to tamp down inflation. What better way to start than with housing? So you take a quick look here in these numbers. Basically, from a year ago to today, I'm not going to go through the numbers, it's roughly 38%. Yesterday, Zillow said 50% more to buy the exact same home a year ago. How? How do you do that? That is going to slow growth as well, right? The cost to own a home has gone through the roof. By the way, I did this a couple weeks ago when rates were 4.7% on mortgages. They're over 5% today. It's ugly, okay? This is a great way to slow down the economy. Now, let's go to the big charts. All right, next up, we're going to go to the charts. We utilize the charts, technical analysis, start with the cycles, reaffirm and follow, make final decisions based on movements within the chart. So we're going to look at a couple different signals and then also take a look at some individual sectors. So first up, we've got the monthly chart. What do we see here? Not a lot of good, right? Continues to go down, okay? A lower close last month, okay? The worst month since 2008. The worst start in the markets since the 70s, okay? You've had a negative crossover down here on momentum. That is not good. So our long-term signal is negative right now. As you would imagine, same thing goes for weekly. We are breaking down here big time. The momentum here is even worse. We are definitively negative on the weekly chart, okay? Next up is your daily S&P, and I'm showing this for a couple reasons. Obviously, very much negative. At the beginning of the year, I called this my most important chart. It's changed. You're going to see a new one. Still very much important, but we are going to look at the bond market as we go forward. So what do we see here? This little box here is your Fibonacci. We've broken through it a couple different times. The most important thing on Friday, on the close, we have a new lower low. a lower close for the year. That is not a bullish sign. That being said, right, a couple things when you look at the overall charts. All right, you should, maybe, could expect a bounce this week because we have extreme oversold conditions, but it still has established a new low. So would not be surprised to see a little bit of a bump. On the other hand, you got to be prepared, okay? We crash in oversold conditions. So that is a possibility as well. Volatility index, we're back at 30, okay? Above 30, uninvestable. Not quite there yet. We've gone up and down. We're right about there. We'll see how the week starts. But down the bottom here might be tough to see. I've set up what's called a rate of change using 1% of a factor. So how much does the market go up or down 1%? You can see where we are last year. And then look over here. Look at that volatility that we're showing right there on a rate of change on a daily basis, which is pretty darn big, okay? Obviously, the next one, the NASDAQ, is down over 20%, which is in bear market territory. Someone came up with that. We're going to follow that thought. Really, really ugly rate here on the tech. We've been out of tech since late 2021. Tough place to be. Now, big story always has been the FANGs, right? And I'll put up an image here of what encompasses this index. This is the FANG index. You are now down for the year, okay, over 30% combined. As the FANGs go, the market goes, right? We saw this week with some earnings. Some got beat up. Some held their own. Mostly got beat up, though, across the board. So then we look underneath the hood. We talk about new highs minus new lows. And you can see, right, the red. The histogram is new highs minus new lows. Bad. Really bad. Okay? This market is hurting. We continue to see more sell pressure. Okay? Last but not least, we're looking at companies, indexes above or below their respective 200-day moving average. Okay? So what do you see here? First off, above 60% is bullish. We now have at the top, we've got 38% for the S&P. We've got 22% for the NASDAQ, 30% for mid-caps, 26% on mid-caps, and that's the thing that's happened in the last 10 days. This has been a broad, across all sector, sell-off, and has not been pretty. Next up, Sector Spotlight. All right, so first up, we're going to talk about the U.S. dollar. In cycle 4, the dollar does well. Holy moly, look at that. That has gone straight vertical, dollar versus other currencies, okay? My only mistake, I wish I had a bigger position. You see when we made the cycle 4 call, has done very, very well. This might be an opportunity to add. We'll see. We still have a decent position here, about a 4% position. But the dollar has really worked out well and are top performing. Think about that. Top performing for the year. Now, we talked about the most important charts. Bonds. The bond market going forward is the most important thing that I'm looking at right now. Michael, you're not a bond guy. But the bond market's going to determine where we go going forward. Let me explain a little bit, okay? A couple things about this. First off, the 2-year Treasury, okay? It is highly correlated to the Fed fund rates, meaning on Fed policy right now, believe it or not, there's a potential prediction you're going to see 9 rate hikes getting to about 2.6%. So we're at 2.7% on the 2-year, and you can see since they started talking about that, the 2-year has surged, okay? Now, down the bottom is the overnight rate, which is 0.2%. When you hear the Fed is behind the curve, that's it right there, folks. 2.7 2-year, 0.2 on the Fed fund rates. Huge, big time behind the curve, okay? Next up is our 10-year. Now, this is the 10-year Treasury. All right, I've gone on a weekly chart, and I've gone back all the way to 1973, right? Obviously, during the Paul Volcker years. Very, very definitive channel, and you can see every time we've gotten to the top of the channel, .com, great financial crisis, Brexit, taper tantrum, we've rolled over, okay? Now, we are right on it, just a little bit above the channel line right now, okay? Now, I believe we're going to go lower. Why? We're going to talk about that right now, okay? So the 10-year is so important to watch. Now, for the normal investor, for our models, right, in a year like this, equities are getting hit. You're looking for non-correlated assets. Gold has still worked year to date. Treasuries, though, have not worked at all, right? Yields have been pushed upwards. So if yields go up, prices go down. You're not making money in bonds. Normally, in volatile times, they will help you, okay? They are not at all. We had the worst quarter in history, okay, first quarter this year for bonds on an absolute return. So why is this the most important chart? Okay, right now, this is being driven by the fact that the Fed is behind inflation. Okay, right now, the 10-year, the Treasury bond, the bond market does not believe that Treasuries are going to be able to, inflation is going to be able to come down right away. So what's happening here? We are very, very underweight. I think we're about 10 to 12% in bonds right now. I'm waiting, sitting on a lot of cash, because eventually, when this market gets really hairy, yes, it's not good so far, but it will get worse. You will start getting a lot of bids, people buying bonds for safety, for quality, the flight to quality that you hear about. That's why, to me, this is the most important chart. I mean, we're now at 2.8 or something like that, right in that range today. You see a lot of downturn. This could easily go to 1.5%. If it does, okay, you can see some really nice returns when yield goes down, price goes up. That's what I'm waiting for in our portfolio as we go forward. Anything else we're looking at? Utilities has been pretty strong, okay, has broken down, but still like them going forward, okay. We've talked about gold. Gold has done well, still a better performer this year, is positive year to date, have not gotten a lot of bids, consolidating. I think that pushes higher as well, and the same goes for gold miners, okay. We do see that, had a great run, had a pullback, found the bottom, okay, consolidating, and hopefully we'll see as we go forward. Next up, game plan going forward. All right, so we talked a lot about their growth. Growth is rolling over. Inflation is going to stay sticky, but should see some disinflation. And the Fed is making a terrible policy error, raising rates into growth slowing, not a good thing. So what do we expect going forward? Okay, and some specific ideas, right? Obviously, follow us for updates, Twitter, Facebook, whatever your preference is, right? The Fed is behind the curve. Watch the yield curve, 10-year -2, not negative yet, but bond yields. Bond yields is going to tell us when it's time. When we start to see them rolling over, that's going to might be one of the best bond buying opportunities we've seen in quite some time, right? Transition into some of those safety assets that we've talked about here in our sector spotlight. All right, if we see some strength next week, sell into strength, raise cash to prepare for the next downturn as we go forward. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.